I know that you've been in the industry for about 5 years.
Yes, sir.
Closing almost $150 million in those 5 years, an average of $30 million per year, which is amazing. You don't hear those numbers often, more than 300 transactions under your belt. How do you accomplish that in such a small time, man?
I think just not giving yourself an option, right? Like Elon Musk said it best, if you give yourself 30 days to clean your house, it's gonna take 30 days, right?
You started as a realtor, did a lot of rentals, did transition from real estate to mortgage. Why and how?
I've always been like more solution oriented, like fix the problem, put deals together. When you're young, all your friends are young, people don't take you that serious, right? Because they see you and they're like, look at that. So I would always try to have like a big beard and I would dress up, dress shirt, dress pants tucked in every day.
So the beard is intentional.
Right, it's intentional.
What are a couple of things that you've seen that most agents, because of lack of knowledge, they don't know how to get around that? Maybe you find that.
There's still a massive misconception that FHA loans are worse than conventional loans, right?
Talking about mortgages, the way that you do, how knowledgeable you are, because most loan officers don't do that.
No.
Don't do the exercise and have all these details figured out.
Or when you can be friends with coworkers, I guess, and make money with them, nothing beats it.
That's awesome. Nothing beats it.
Nothing beats a jet through holiday.
All right, welcome to another episode of Tiki Talks. Today I have a good friend and business partner. He's in the mortgage side. He's a young guy that has been doing a lot in the mortgage industry here in South Florida, building a lot of connection, closing a lot of business. I want to get to know more about his story, what got him here, and talk about loans and opportunities that I know that some other realtors are not taking advantage of. Eric, I know that you've been in the industry for about 5 years.
Yes, sir.
Closing almost $150 million in those 5 years. Talking about an average of $30 million per year, which is amazing. You don't hear those numbers often, more than 300 transactions under your belt.
Right.
How do you accomplish that in such a small time, man?
I think just not giving yourself an option, right? Like Elon Musk said it best, if you give yourself 30 days to clean your house, it's gonna take 30 days, right? But if you give yourself...
Started dropping gems already.
Yeah. if you just wanna hit like the ground running and you have your goals in mind, just give yourself no other option.
Let's go back a little bit. Do you went to school? Do you go to school?
No. No college. I tried going to college, wasn't for me. 2 classes.
Really?
I went to 2 classes, didn't like it, and I said, I'm out.
Gotcha. What do you used to do before mortgages?
I've always kind of been in sales or like high-paced job, right? So my first actual job was at a law firm, so I kind of learned the professionalism there at the law firm. Then I worked at the Lexus dealer in North Miami, so I kind of learned...
Really?
Yeah, how to talk to people, how to treat people.
Selling cars?
No, I worked in the service department.
Gotcha.
But still, you would see like the service advisors selling to people coming in mad, people coming in happy, high-paced jobs, how to resolve problems, put out fires. So I worked at Lexus for about, I would say, a year. Then I got into real estate. I became a realtor. Did that for 2 years.
2 years.
2 years.
What happened? I mean, 2 years. What happened there? Like,
this is how I got into it. I was sitting at the Lexus dealership making like $11 an hour, right? I was like an 18-year-old kid. And then my dad has been a realtor for a very long time. So I was doing the math. I'm like, my dad gets paid 3% on like a $400,000 house, right? It's like $12,000. And I'm like, I probably make that a year here working at Lexus, right? So I'm like, all right, let me do it. Because I didn't want to get into real estate. And then to touch on the school topic, my parents wanted me to go to school. So my dad's like, okay, I'll let you work with me, but you still have to go to school. So then I became a realtor, started doing decent as a realtor, went to school, failed 2 classes. I said, look, Dad, not for me. I just didn't want to be there, right?
Yeah. I can see that you feeling that the pace is too slow for you.
Yeah.
You wanted to implement yourself and put in yourself.
Exactly. So I started selling houses, doing a lot of rentals. I did a lot of rentals in my career. I think in like the first year of me being a realtor, I did like 20 transactions.
Yeah.
A lot of them being rentals, but again, just fast, and then got into mortgages.
Wow. So you started as a realtor, did a lot of rentals, did transition from real estate to mortgage. Why and how?
The timing was just kind of fine, right? Not because, it was like the refi boom of a lot of people want to think, right? I generally had no idea that rates were even that low, right? I was a guy that worked in my dad's office that was always in mortgages. A lot of my friends had no idea what to do were already becoming realtors, right? So I was like, there's already a lot of people becoming realtors, and I've always liked mortgages. So I was always seeing mortgages with my dad's office manager that did mortgages half the time.
Yeah.
I don't know, numbers, I've always been like more solution oriented, like fix the problem, put deals together.
Yeah, getting creative.
So an opportunity arose and I just jumped into the mortgages.
That's crazy, because I do remember you being in real estate. I'm sure you remember. We met the very first time. You brought a buyer to one of my listings that was back in Miramar. Back then, I mean, I'm sure that you were either
18 years old, probably.
I mean, 18, yeah, around
18 years old, yeah.
Either ending or starting the 2 years, probably in the middle.
No, that was, I remember that lady's name. Her name was Yolanda.
Yeah.
And it was a Mamey colored house in Miramar.
Yes, correct. We met for the inspection, but I remember you being quiet, kind of like learning and stuff. It didn't work out, that deal, but I remember like you putting yourself out there. And then you transition into mortgages. How are you able to do so much volume and so many transactions, again, in such a short amount of time being in the industry? And this is why my curiosity, and I want to hear everything you have to say. You're young, and it takes time to build a portfolio of clients. It happened to me. I've been doing this for 10 years.
Right.
And when you're young, the relationships that you have are young too, young professionals. So how do you get yourself in the right rooms to meet the right people, let's say? So
it's funny because when I was a realtor, I would always the same thing, like what you said, when you're young, all your friends are young, people don't take you that serious, right? Because they see you and they're like, look at that. So I would always try to have like a big beard, and I would dress up, dress shirt, dress pants tucked in every day. So the beard is intentional. Right, it's intentional. Now I could probably shave it off, but it's like a staple at this point. But I would always try to act more professional, right? I was quiet, I would try to be as proper as possible. So in the beginning, it was definitely difficult. But then when people saw how I acted and I knew all my stuff, it was kind of like a breath of fresh air. They're like, oh, look, it's a young person to work with, and they actually know what they're doing, and they're in my best interest. So once I was able to kind of build a little bit of a clientele, nothing, it's just being a people person, right? Leveraging relationships, talking to as many people as you can, being friends with as many people as you can, and I remember getting into the industry and I would see like these crazy numbers that people would put up, and I was never complacent, right? That's actually why I switched from being a realtor to doing mortgages, right? Because as an 18-year-old kid in my dad's office, I was doing decent, right? Everybody there was doing good for themselves, but I'm like, I want more. I want more. So then I started doing mortgages, and I surrounded my people with people doing way more. And talking about people doing way more, who are those people? Who do you think that are those key people that have helped you and coach you through the process, and mentors to help you get where you are? So the work ethic definitely comes from my dad, right? My dad is 60 years old, like retired, and he still wakes up every day at 5 in the morning, goes to the gym. Wow. So, he flips houses, right? He still shows houses, right? He doesn't need to, but for him, it's like the second you take that away from him, he dies, right? He just can't stay still. So I get that from him. Robert as well. Robert, me and him, he's the only company I've worked for, and his brother, right? So at one point it was only me, Robert, and Jose in a little tiny office, and it was just the three of us. Back when they started, when Elite started. So I was actually the first employee of Elite. Wow. Before Jose. Really? Because Jose had his license still somewhere else. Oh, I didn't know that. Yep. That's awesome. So it was literally just me, Robert, and Jose sitting in an office, a tiny office, just going to war, and we would stay there every day. And I've always been that person that like needs to know everything, right? Like there's not a question you ask me that I won't know about mortgages. So is that how long the company's been open for? The Elite Lending? Oh wow, I didn't know that part. You always lead in the charts, and the top producer charts in the office. Being so young, I'm like, okay, he's been proactive. You obviously have the competitive inside you, but you also grind it out even from the beginning of the company. Yeah, since day one we've been there. That's awesome. Since day one. That's awesome. Since day one. So right now, most of your business, where does it come from? Personal referrals? Do you focus more on the investment side, investment loans? So most mortgage brokers, I say, obviously our key book of business is realtors, right? I have a lot of investors that just kind of come to me already saying like, hey, like their wife may be a realtor. They already have their realtor. They already kind of know their strategy. Or they'll buy deals directly from other people, and they'll just get a title company involved. So I'd say 50%, no, not 50, maybe like 30, 40% of it are investors like that. Or people that are playing around with their money, like they'll get a line of credit, they'll cash out on their house to buy another house cash, and then cash out, refinance that a couple of months down the line. And then realtors, right? Realtors is the main book of business. And it's honestly the funnest part of my job, right? Like working with realtors like you and the other guys that you've met and talking with them on a daily basis. That's the fun part. When you can be friends with coworkers, I guess, and make money with them, nothing beats it. That's awesome. Nothing beats it. Nothing beats a jet through holiday. Every time that I'm around you and Robert, you guys always talk about new loan products that no the traditional loan officer talks about. Most of the realtors know about FHA and conventional, FHA and conventional. On the lending side, there's the creative part of other products that the average loan officers don't know or doesn't tap in because they just simply don't get themselves into. It's a little bit more complicated. It takes a little bit more work. So would you agree it's because of that? Why? Yes, I would agree it's because of that. And it's funny because a lot of those guys that I was telling you that do the crazy numbers when I was starting to do mortgages now, they stick to that FHA and conventional conventional, and then they're like, hey, how did you like blow up so fast? And it's because of these
You get
loans
creative.
that they take a little bit of work, and these older guys don't, not that they don't have to do, but they don't want to, you can't teach an old dog new tricks apparently, kind of that mentality. But yeah, we can go down a rabbit hole. There's a bunch of different loan
So
products.
what would you say are those maybe top products that you think that most loan officers are underusing?
So non-QM, a lot of people sell it short, right? We talk about it a lot, so we sound like broken records, but there's tens of, not hundreds, but there's tens of non-QM products that people don't even use. Like that deal we were just talking about with the refi that I just did, it's a P&L program, right? So it's a husband and wife. The husband has a really good W-2 job and the wife is self-employed, right? For whatever reason, I couldn't show her business bank statements or whatever. So as long as you can get a CPA that did her taxes, which they already do this for them anyway, saying, hey, look, this is the profit and loss of her company. This is what she's bringing in. These are her expenses. I can use that as income.
Wow.
And then it gets even a little bit more intricate because I can use the primary wage earner's credit score. So the wife didn't have great credit score, but the husband did. The husband made a little bit more money.
Yeah.
So I was able to use his 740 credit score instead of her 640.
Gotcha. Those type of loans that doesn't require to use your taxes necessarily in the case of businesses?
Correct. So non-QM just really stands for non-qualified mortgage, right? It's not like conventional.
Not the
FHA.
conventional FHA or...
But you could use your taxes. I'm doing a lot of them that they do require seeing taxes. But like, look, for example, like on a normal jumbo loan, you know, those are like super documentation heavy, right? Like 3 years of taxes for the most part. Like you can't go from living in a primary to another one. You can do 1 year of taxes on a non-QM loan. Or if someone wants to buy, like, look, for example, in the ARIA, right? A lot of those people are well qualified, but the condo doesn't qualify conventional because the pool's not done. So I can use non-QM, I can use your taxes, I can use all the other stuff. They get a really good rate, but the actual property doesn't qualify itself.
You said that there are multiple types of non-QM. What are the main difference between one another? The type of documentation that is required?
The type of documentation, right? So there's the bank statement loans, which is the most common. There's the P&L, which is pretty common. The DSCR, people talk about DSCR all the time, right?
It's very common.
Yeah.
Correct me if I'm wrong. It's that one that where the loan it's underwritten depending on the property and the deal. It's based on the rent roll and the investment case, and not necessarily on the individual.
Correct. It's asset-based lending, right? So there's DSCR. A lot of people just say, oh, as long as the mortgage covers the rent, you're good to go, right? Yes, right? But let's explain it a little bit more in detail, right? So it's asset-based lending. So as long as the debt is covered by the service, so as long as the mortgage is covered by the rent, you're good, right? To sum it down. But there's different brackets of it, right? Like for commercial properties, the DSCR has to be 1.25. So if the mortgage is $10,000, the cash flow that has to bring in is $12,500. If you're doing a house, right, there's different products of it depending the rate. You can do 0.8 DSCR, 1-to-1, over 1.25, right? So usually the better the asset performs, the more leverage you can get on it and at better terms. And you can do it for refinances too, so it's really good. Like people that have investment properties and have no way of showing income, but they can show that they've been collecting rent for 5 years. As long as you can take out as much debt as you want, as long as that doesn't cover whatever your rent is.
Got you. That makes sense. So, and you touch on that too, commercial, which again, most loan officers don't do. But you can do under your license commercials loans. Is that correct?
You don't even need a license to commercial. So
you don't need a license.
No, you just got to really know what you're doing because commercials, you know, it's
a different animal.
Different animal, but yeah, you technically don't even need a license to do commercial loans because they're all business purpose.
Got you. So in your case, and that's the part that you also have, that you coach people and deal with people that on the investment side, not only the traditional primary residence or maybe second home, but multifamilies, investment properties, fix and flips. Those type of loans you can do as well, no?
Yeah, those are actually the easiest, right? The biggest, I guess, prerequisite to have for fix and flip. If you don't have it, that's fine. But as long as you can show history of fixing and flipping houses, you can get like, people don't know this, you can get 90% of the purchase, so 10% down, and even like 100% of the rehab.
Wow, 100% of
100% of the rehab.
Meaning I buy the house, I only have to bring 10% down, and then whatever money I need, it has to be a quantity that makes sense, you're gonna lend me that money too.
There's two different ways to do it. You can do it in draws, or you can literally just get, you know, like plans from a GC, architect, something like that, and you can do a one loan. They'll give you the whole lump sum at closing.
That's crazy. You hear that, guys? All the people that want to fix and flip and they don't know where to get the money from. So And that's why I wanted to talk to you, because obviously the moment you start talking and you get technical, most realtors, they don't know these things. And I've shared that before. Like,
Right.
I don't want to know all the loan products. It's not my job. My job is to get the house when I'm working with the buyers, get the best deal, negotiate that. And if I have a partner that I trust, I know their things, it's like I just put them in contact with the borrower. Might want to know and understand the basics, but not necessarily all the details between that. In your case, and we talk a little bit about loan officers, but with realtors, what do you see that more real estate agents are lacking right now when it comes to dealing with loan officers and loans?
I think not that they lack, but a lot of them want to get too involved, right? A lot of them want to get too involved, and like.
So it's all the opposite. It's not that they don't get involved. It's like they get too.
They get too involved with like the mortgage process, right? Like I'm not trying to get involved in your negotiations or something. I tell you, hey, maybe like try to get a seller credit because these guys are tight on money. Yeah, but I'm not gonna ask you for the inspections, look at them over, and then say, oh, this house is messed up, trying to get seller credits, or hey, I don't think you're doing a bad job. Like what you said. I trust you that you're gonna get them a good deal. You're gonna do what they have to do, and then you just trust me that I'm gonna get it to the closing table with the best possible terms and put the client in the best possible financial. That kills a lot of deals, I think, because a lot of the realtors will like.
They wanna get their hands on
they
the entire process.
Too emotionally attached to it.
Their baby, their clients, and they wanna solve all their problems, and that never helps. You deal with a lot of real estate agents when it comes to the traditional part. FHA and conventional. What are some maybe challenges that you're seeing that people are coming across with those vanilla type of loans, the more traditional ones? I'll give you one that I asked you the other day. Is there a way to go around that rule? I deal with a lot of investors. They fix and flip, and a lot of the times they flip the property so fast that it falls within the 90 days resale rule that FHA has. So if they buy the property today, they flip it in 4 weeks. We put it on the market in week 5. We steal another month and a half before the 90 days. So that means that the ultimately end buyer cannot purchase with FHA, and that limit us in that aspect.
Especially in a specific purchase price, right? Because in that price point, a lot of the files are going to be FHA.
Yes, exactly. Which most of the deals that we do are in the average price point here in Broward, let's say, which is $500,000, $400,000 to $600,000, and that's kind of like the FHA loan limit, no?
FHA loan limit is $654, I think, right now. So yeah, you're right there.
Yeah. So what are a couple of things that you've seen that most agents, because of lack of knowledge, they don't know how to get around that? Maybe you find that.
Get arounds. Kind of difficult, but there's still a massive misconception that FHA loans are worse than conventional loans, right? The only downside might be like that, where you're purchasing a house and the 90-day flip rule comes into effect.
That's a good one too, yeah.
Yeah, but FHA loan is just as easy as a conventional loan. So is VA. The only difference with VA is you have to get a termite report, right? VAs are actually the easiest kind of loans because legally the appraiser can call you if it comes in low. So let's say you're selling a house for $600,000 and the comps don't support it. It's going to come at $550,000. The appraiser will literally call me and say, "Hey, I did the appraisal. It's coming in short. Do you have better comps?" That's fucking nuts, right? Like that they can legally do that is nuts. So VA loans, I don't know why people don't like them. Yeah. But that's the best loan program that there is.
But that's a good one. When you touch on that, that's a very big misconception. Putting myself on the buying side, I'm mostly on the listing side, but putting myself on the buying side, especially in the market that we were 2 or 3 years ago, where it was multiple offer situation. If I was representing a buyer, I was competing against other offers. So I could have an FHA buyer. The listing agent is telling me, yeah, but I have the same offer, but it's conventional. And I'm trying to tell them, yeah, but we can get other terms to beat that other offer, except that mine is FHA. And they're weighing that other offer just on the fact that it's conventional. So, but when you look at it from the perspective of what you were saying, there's not much of a difference. It's like, yeah, but conventional, it's better. Conventional is better.
Like, I wonder where it came from too. Like, did they teach it in the real estate class? Like, that conventional is better. I don't know.
The only things that I've encountered as a listing agent when it comes to FHA, that on the appraisal side, that's the only risk. It's what the FHA appraisal is going to require that a conventional appraisal won't. And the typical thing that they bring, regardless of the loan, is what is it called? The smoke detectors.
So there's actually this. I've learned this a lot doing a lot of FHA. Chipped paint is the biggest red flag for FHA.
For FHA.
rotten fascias and chip paint.
Yes, that's true.
Those are the biggest things. They're easy fixes, right?
Yeah.
They're annoying to have to deal with, but the only difference is the appraiser has to take a picture of the attic if there's an attic. So he'll just literally open the attic, peek his head and take a picture. If there's fascias that are, eaten up
rotted.
or rotten, something like that, or if there's chipped paint anywhere, it's a health hazard, right?
Yeah.
So it is a little annoying to deal with, but especially now in a buyer's market, the sellers, in my opinion, just gotta suck it up.
Correct. No, but that's good to know. It's true.
Yeah.
Fascia boards, smoke detectors, taking pictures of the attic. There's no way appraisals, they don't get on the roof.
No.
The only way that they know what's the condition of the roof is they have some sort of report.
Yeah,
it's visible damage.
Exactly, visible. Like I think a lot of realtors think that appraisers are home inspectors. They're not home inspectors.
Yeah.
They want to get in and out of there as fast as possible, right? They're gonna see how fast they can take the pictures and do the comparables, right? And a lot of people think like condition of the house, yes, it does outweigh, but a lot of people want to bring the appraiser in to see how remodeled the kitchen is. Like it doesn't matter how remodeled it is. It's in great condition, good condition, okay condition, or below average, right?
If you see an appraisal report, it's just boxes. It's just check boxes.
C1 through C5, I think it is.
They don't put comments. Oh, I love the counters. Like
wow, that caulking job was great. It was seamless. Let's get an extra $500 in value.
Yeah. They might say it. I've had appraisal being so impressed. Oh my God, this is beautiful. And I'm in my head, it's like, oh, I'm glad that you love it.
Yeah.
If you love it, I love it too. But when it comes to the stuff that matters, to compare one from the other, like that's minimum. And if those things, the house that we're talking about, they don't have rotted fascia board, they don't have smoke, there's no risk on one or the other.
No, a lot of things too that I see happen a lot too is realtors or listing agents not lying, not saying the truth about efficiencies, right?
Yeah.
And especially like in places that have the reoccupancy, like Hialeah, North Miami, Miami Gardens, Opa-locka, all these places that have the reoccupancies, the efficiency for the appraisal and the efficiency for the county or for the city are two completely different things, right? If a house has an efficiency and you're doing an appraisal on it, it's financeable. It's not the end of the world as long as the whole house communicates. Right? So like, let's say the most common one is a garage. People will convert the garage into an efficiency. As long as the garage door is still there, not the exterior one, the one that connects, let's say, from the garage to the kitchen, communicates, you're good to go.
Really?
That's fine, yeah.
Regardless of the type of loan?
Regardless of the type of loan.
So the only issues usually, depending on the city, is the reoccupancy, but that's a city thing.
Correct. And as long as the house communicates for the more, and you just got, if there's a stove, you put the stove in the backyard, right? The specifics of it are is because if the whole house doesn't communicate, it's technically a duplex. So if you have to go in through the garage, through the exterior, and out through the exterior, it's two different units technically. So at that point, it's a duplex. It's not zone duplex. You got an issue.
Correct. Yeah.
And even if it doesn't communicate, you put a door and that's it. Which
is another misconception. That's the thing. A lot of realtors, they get misinformed. Some of them, they never get informed. They make assumptions. Houses with some sort of renovations without permits, like that doesn't, in majority of the cases, and correct me if I'm wrong, even on the lending side, has no difference.
It has no difference. Even if things are done without permits, I learned this a lot too when I first started. If things are done without permits, like in addition to the house, like clearly done without permits, like you can tell, like you have a shingle roof and then that part is just an addition with a flat roof.
Yeah.
As long as it's common to the area, you're fine.
You're fine.
They were literally in Hialeah, notorious, right? All the houses in Hialeah for the most part were like 3 1s, 2 1s that they added an addition, right? To put like an extra sala or living room. It's common to the area, you're fine.
Yeah, because when it comes to permits, that's a city thing.
Right.
If the city has an issue, which those are the ones that approve or deny permits, if the city has an issue, then it becomes an issue.
Right.
But if the seller did some sort of renovation, update, addition, without permits, that's a risk, but it's a risk with the city. When it comes to the loan, it has nothing to do. And I find myself coaching agents all the time and I'd like to say this, it's like, when I'm talking to agents, if I go to your house tomorrow and I check your entire house, I'm sure you're gonna find, I can bet you money that I'll find a few things that was done in the house without permits.
100%.
By you or the previous seller. If you come to my house, there's gonna be something there. Because the city usually have the rules when it comes to that, to change a toilet. Some cities require permits just to change a toilet. Majority of people don't pull permits for that.
No.
So So those are misconceptions too that people, realtors, don't inform themselves with, and that's information that you want to know.
Right.
You don't want to leave it to the lender.
Yeah, like I'm not. I tell people all the time, right? I'm not the police. I'm not the FBI, right?
Yeah.
But if you tell me the issues up front, I can at least tell you how to navigate around them. It'll save time and money because, like on the appraisal subject,
Yeah.
we're gonna get the appraisal report. The appraiser is gonna be more like the police or whatever, right? So when that report comes to me and it says, hey, this is wrong with it, and we're on a tight time frame to close, and then they make it subject to. So there's two different ways appraisals can come.
Yeah.
As is, meaning you're good, the value is as it is, or the value is subject to you making these repairs. So when it comes subject to the repairs being needed, and then you gotta tell the client that it's an extra $250 for the appraiser to go back out there and it's gonna take another
Yeah.
week, it's like, bro, if you would have told me this from the beginning, we would have
Yeah.
saved some time and money here.
That makes sense. Where do you see the mortgage market going in the next few months, maybe a couple of years? What is the ongoing conversation on that side of the industry?
My biggest enemy is rates, right? Everybody's talking about rates, and I see this all the time. Rates aren't that important, right? And there's like a big misconception that rates might go from like 6 to 5, right? Rates change at 1/8% at a time. So it might go from a 6 to a 6.125. Then the next day it might go up, then it comes back down again. So you're never gonna see a drop of like a whole percentage or 0.5% in like a month, even 2 months, right? So it's a blessing and a curse. A lot of people focus too much on the news. I think that rates are gonna come down. So maybe will be more buyers going into the market. But it's been pretty stable, right? Obviously, the market's kind of slow. But when buyers hear that rates are coming back down, I think it makes them feel a little bit more comfortable. So I think applications and the market will pick up a little bit.
That makes sense. And while we wait until that happens, there's other things that can be done and get creative. For example, buying down the rates.
Right.
That's a thing that's always been around. You could have always buy down rates.
It's always been around, and it's funny because back then nobody wanted to pay points. Now it's the complete opposite. Everybody wants how many points can I pay?
Yes.
And I tell people I swear.
So even when the market was in the 2-3%, you could still buy yourself down.
You could buy it down.
More.
At that point, nobody really wanted to because it'd be like points, no points, no points. Like I'm like, all right, we don't gotta pay no points, right?
Yeah.
And then it's a misconception too that people think the more points we charge, the more money we make, which it's not true. Like we're gonna make whatever we make normally, and then the rate, the higher the rate, you might get a credit back, or the lower rate, you're prepaying your interest up front, right? So I literally have people that are asking me now, like, hey, how many can I pay 5 points? And the answer is like, no, right?
Yeah.
After 2008, the buyer can't have more than a 3% cost to get a loan, with like origination charges, appraisal, and all that good stuff.
So that's usually the threshold. That's the limit.
They can't have a cost. That is a limit. It's a legal limit, 3% of the loan amount.
Gotcha.
With certain fees like origination, processing, underwriting, appraisal, credit reports, stuff like that, it can't pass 3%.
You can pass 3%.
It can't pass 3%.
So whatever remainder of those 3% is what you can use and apply to buy down the rate.
Correct.
That's right.
If you get a seller credit, it offsets it. So you've seen some people that'll get like a $10,000 seller credit and they pay 4 points.
Yeah.
Because technically the seller is paying for it.
Got you.
Right? So there are ways around it. But in my opinion, I say it all the time, it doesn't make sense to pay a lot of points anyway.
Yeah.
I think the average stat is the person stays in the house or refinances it every 5 years. So if you're gonna pay $20,000 in points to save $150 a month,
Got you.
you're not gonna see that savings within 5 years.
Yeah.
Money thrown out.
Then that's where it case by case comes down. But if I'm buying with the intention to stay there for 10, 20 years, then that's a different conversation. And that's where I tell people, and I try to tell agents, new agents that I coach, it's like take advantage of on the opportunity in this market when it comes to the equity in the properties.
Right.
Don't just go by trying to get the best deal by getting it for less.
Right.
Use that equity and apply it towards buying down the rate, getting your buyers closing costs. There's just so many things that you can do with that money instead of just getting it for less. Because ultimately, a $10,000 reduction or getting it for $10,000 lower, it has way less of an impact than if I can get you that money cash and pay, say, down your closing costs.
I did the math on like a $400,000 loan amount. I think $11,000 in lowering the loan amount was like $37 a month. And then on an FHA loan, the points are a little bit more effective. But on FHA, if we bought $10,000 worth of points, it brought the payment down like 147 or something like that.
Wow.
So a lot of people's more, I heard this thing the other day where it's true, right? People don't, when you ask someone how far you drive, it's 7 miles away. It's 15 minutes.
Yeah.
Right? It's time, right? Instead of length.
Yeah.
So the same thing with buying a house now. People don't really care about the price, they care about the payment.
It's true.
So
And even on the real estate, which is another tip for those realtors, maybe newer realtors, when they are doing their buyer consultation, which is something that I always tell, and this is more on the real estate side, like don't take a buyer the same way that there's no way for you to issue a pre-approval until you talk to that buyer, because you want to make sure that you take care of that buyer and match it with the type of loan that it works for whatever they're looking for. It's the same thing that I tell realtors: don't take buyers without doing a buyer's consultation. And in that buyer consultation, part of my process and the main question is, how much are you willing to pay on a monthly basis? What is the very max for that? Of course, we're going to try to get the property for the lowest amount, but monthly payment wise, don't tell me how much in price, because that varies.
it's impossible.
And I for first time home buyer especially, I try to explain, you have a house and your neighbor has the same house. Your neighbor, both of you are selling it for the same amount of price, but there could be a difference of $400, $500 per month in payment.
100%.
People may ask why. It's the same house, same price. Well, taxes, insurance, HOAs, MI, all of that.
That happens. That what we just spoke about is a really important nugget, because a lot of first-time home buyers, I was literally having this conversation yesterday. When I asked them, do you have a price point? No. All right, so let's play the monthly payment game. Where do you want to be at monthly payment wise? I don't want to pay more than $2,000 to $3,000 a month.
People are afraid, buyers, and especially that's the part that us realtors need to work on to build on the trust, so they're able to tell you. Because when you ask that question, they don't want to tell you because they feel like you want to max that out.
Yeah.
People are afraid to, thinking if I say this number, that's what he's gonna get me.
Yeah.
No, just give it to me, and my job is to get it for less.
That's one of the things that I try doing the most, right? Like if I have a sit down like pre-approval process or whatever, like some clients are scared to tell me the number or whatever, right? And there was literally a guy, I'll never forget this. I did a pre-approval in person, and the guy, I'm like, what's your budget? He goes, no, I don't have a budget. I'm like, 100,000, 200,000. He goes, no, a little bit more. I'm like, 5, 6. He goes, no, higher than that. I'm like, 17 million. He goes, no. I'm like, bro, you have a budget.
Yeah,
what is your budget? What is your budget? And it's going back to the $2,000 to $3,000 range. That is the hardest price point to get someone pre-approved for right now, because you're gonna find condo, maybe townhouse.
Yeah.
And the HOA is usually the biggest expense, right? So the same thing with the house, right? You can find 2 condos, 3 blocks away from each other, 2, but one has a special assessment, and the HOA is $795, and the other one is $295. It's a difference of $500 a month.
Yeah.
So that is the first-time home buyers that want to stay within $2,000 to $3,000 a month is the most difficult client to kind of guide in the right direction.
At least in our market.
Yeah.
If you want to buy a house in today's market in South Florida, and your budget is $2,000 per month, right now it's very difficult. I never say impossible. I don't like to use the word because you never know. If you find the seller willing to sell it for dirt cheap, those are gonna be the numbers. But that's almost impossible.
It's almost impossible. And then you can't. And then my go-to line is, look, we can probably find something now that's $2,500, but the HOA might go up in 3 years.
Correct.
So I try to always not steer them, but say, look, you can pay $2,500 for a condo, or maybe pay $3,000 for a townhouse, and your payment's kind of a little bit safer there instead of the condo.
And what I've learned too in our market, if it sounds too good to be true, it's because it's too good.
Probably too good to be true.
Because then they start sending me properties. First time home buyers, they send me properties. And it's like, oh, that's in a 55 plus community. Are you 55? No. They send me properties in Boca. Do you know that property is in a what is it called? In those communities that has country clubs where you have to pay
land lease or initiation fees, yeah.
Yeah. $70,000, $100,000 out front because it's in a golf court. Or
they'll send you like short sales on Realtor.com or Zillow that it's like a house in Hialeah that's like for $395, and they're like, oh my God, it's like, it happens all the time.
That happens all the time. So that's why you have to work with people that know what they're doing in this aspect. And always connect with the lender first. Know your numbers, and you have to trust the lender and the realtor and get naked financially, have open conversations, and just trusting that they will do, with that information, they will do what's best for you.
I agree.
Because if not, then if you limit the information. I'm gonna figure it out with that limited information, and then you're gonna get disappointed because you didn't get the house that you were looking for. That's awesome. And what are your thoughts on when we're talking about the interest rates and the mortgage payments being $2,500, $3,000? Because you don't hear those numbers now for a single family and stuff. This creative financing, where some investors are getting pays mortgage, I'm sure that you've heard of it, taking over the mortgage. We're seeing that more often. What are your thoughts on that, if you have any?
It's come about a lot, right? Especially when rates were really high, like 7%. I would even see realtors put like in the broker comments or on Zillow, like assumable mortgage, which it's great, right? Going back to the only guaranteed assumable mortgage is your FHA. The person that's buying FHA is not super liquid, right? So, and equity's at an all-time high, right? So it kind of pieces together the whole puzzle right now. So there's someone that has an FHA loan that probably refied during COVID that has a 2-3%, and someone wants that 2-3%, right? Say they owe $250,000, but now the house is worth $400.
Yeah.
What's gonna happen from that difference of the $250 to the $400 they're gonna sell it at? You have $150,000 liquid. If you do, perfect, right? If you can assume the mortgage, but the issue comes about where you're gonna probably have to get a second position lien, which might be a home equity line of credit, or a second mortgage, and that second mortgage is gonna come at 8, 9, 10%.
Yeah.
So you do the blended rate.
Like upset.
So you do perfect. I have a 2.5 and a 10. I have a 12.5% interest rate on my house, right? When I do 12.5 divided by 2, it's what, 6.25?
Yeah.
Same thing as gonna do mortgage.
That makes sense.
So if you're an investor that can assume mortgages, on commercial buildings, and you have the liquidity to do it, and because you have to be at a low LTV anyway, it makes all the sense in the world. But in regards to assuming mortgages on houses, I have yet to see one where it actually happens.
Work out. Yeah. It has to be like the exact amount of equity that the investors is willing to put down to. Because still, if it's decent, to your point, if it's decent amount of cash, it's like I'm parking money on a house.
Right.
So you said that it's only doable in FHA?
Guaranteed doable FHA. Every FHA loan is assumable.
Got you.
Yeah. Okay. There are other loans you might be able to do it, but fun fact, if you actually look at the disclosures, the closing disclosures of the FHA, it'll have a box checked off and says this mortgage is assumable. Yeah. On all FHA loans.
That's interesting. That's interesting. Man, it's very nice hearing you talking about mortgages the way that you do, how knowledgeable you are, because most loan officers don't do that. Don't do the exercise and have all these details figured out. They might know, again, just what FHA requires, conventional requires, and that's it. But the beautiful thing, and that's where the danger is if you come across a loan officer that it's only looking through the lenses of conventional FHA, and if by any chance you don't qualify, they tell you, oh, you don't qualify. And then you miss the opportunity of buying at the right time. Right now, even though the interest rate might be higher, you can still get very good deals when it comes to price. We were talking about that before jumping on the episode, that I'm finding I want buyers in this market. I want qualified buyers that they're ready to purchase.
It's funny how the market switched, right? Yeah. Before everybody wanted listings. Now
right now I want buyers. And the reason is because I know how to work out with buyers. A lot of realtors, they don't know how to work them out, and they waste out a lot of time in the process. That's why the famous saying, buyers are liars, because they have to show them 20 properties before they want to make an offer, especially in this market that they have so many auctions. But in my case, like I have a buyer consultation, I have like a streamlined process set down where in average, and I track that number, it takes me around 6 properties before they make an offer. And so when you put it in perspective, the amount of time that you can show 6 properties in one day. Right. So, and then the beautiful part is like I found them the property, and now as a buyer's agent, I have the leverage in all aspects to negotiate, because more than likely they don't have an offer on the other side. They're coming back to me for feedback and giving me everything I need just to put that deal together. And then I come to you and it's like, Eric, we have this much equity. I know that I can get, I don't know, $40,000. What can we do?
That's the best way to do it, right? Because a lot of when you get a seller credit, your options are disposable, right? You can do the buy down. You can buy down your rate permanently. You can just use it to cover your closing costs. So the way the market is right now, like a realtor will come to me and say, hey, we're negotiating this deal. What should I do? I say, look, negotiate the biggest seller credit you can, right? Yeah. Make sure the property, you're not gonna jeopardize the property not appraising and then it going down. And then we'll find the best course of action for the clients.
Correct. Yes. And that's a beautiful thing. It's connecting before, because that's probably you get annoying, because I know loan officers might. When you submit an offer, you negotiate all the terms, and then I show up, oh, this is when we negotiate, and you get surprised. It's like, actually, at those numbers, my client doesn't qualify.
I like to do it different. I told all the realtors that I work with, when they send the offer, and it's funny because when they send the offer, I always like send an email, hey, just chime me in, just so you know I've checked everything out, and it works for the most part. I like doing it too, because then more realtors know my name. So when they see that email come in, they're like, oh, okay, it's Eric doing the mortgage. I know he checked everything. So we'll kind of go over the numbers before we do it. But to get back to the email part, sometimes now I don't even have the chance to respond.
Yeah.
Like by that time, the sellers have been waiting for an offer so much that the listing agent called the buyer's agent. They're like, oh, okay, this is what we need. So when I respond, like if they send it on a Saturday at 8 o'clock, Sunday morning when I respond, they're like, oh, we're already under contract.
Yeah. Which is another thing, guys, take note. Make sure that the loan officer is not supposed to be part of the negotiation, but make sure that you're informing them throughout the process, because the more they know about what's being negotiated as far as the numbers, a proactive loan officer will be in their computer rerunning the numbers to make sure that everything is tight.
Yeah.
Because I've seen it all the time, and it's frustrating when you get that confidence from a loan officer. Yeah, the buyer qualified. Yeah, pre-qualified then. And then down the route, 2 weeks into, everybody wasted their time because they didn't update those numbers, or they missed one.
Overpromise. A lot of people overpromise, right? Lately, I've been not saying no more than yes, but what I've been seeing is, I guess, because everybody wants more deals now because the market's slow. A lot of the realtors are overpromising to the clients, right? Like they'll say like,
My loan officer will get you these.
Exactly. Like there was a deal that we were talking about in the office that this guy literally just bought. He refinanced the house as a primary residence. And then there was no realtor involved, it was a refinance. And then he has this realtor he's worked with in the past that he wants to buy the guy lives in Miami. He wants to buy a house in the Keys as a primary residence. And we're like, yo, you can't do that. You just refinance this saying it was your primary. You live in work in Hialeah, then you're gonna buy a house in the Keys saying it's your primary residence, and the realtor's like, oh no, my mortgage broker does it all the time. Like, this is a recipe for disaster. Correct. Who's doing this?
Yeah, 100%. So it's like you want to work around the law, but always following the law, because like everybody, we are licensed. We can lose our license at any.
And the worst part is, some people will do it or get under contract, and 2 weeks down the road, it's not even because anyone did anything wrong. It's literally like, I told you this wasn't gonna work from the beginning, and now you have to. There's a lot of explanation going on.
Correct. It's like attorneys. You want to find the loopholes. You want to find, this is the rule. Well, this is what I interpreted, and it works out. But it's not that you're going to go against the rule.
There's a lot, and we can talk about this here for briefly. There's Fannie Mae and Freddie Mac. They're spending tremendous amounts of money on AI, investigating mortgage fraud, but more into occupancy fraud. We've had a lot of files in the office that people say, I'm going to move into this.
Yes.
I'm going to do this. And remember, at closing, guys, you sign a piece of paper saying, I am going to occupy this house within 30 days and I'm going to reside in it as my primary residence, right?
Yeah.
They will go back to it, and there's ways of searching it. They can do a postal search and see if you changed your license, if your mail goes to that house. There's ways of checking all that stuff.
Information right now, everything is being so connected, and makes sense adding AI that there's ways, if they want to, there's way that they can. And
they will call a note due. They will literally call. I have a client that they will send a letter to your house saying, hey, you lied on your mortgage application. You signed here. You have 30 days to pay me back. And then that is a super uncomfortable conversation.
That's an uncomfortable conversation.
Because then they have to sell their house, and if they bought it with 3 or 5% down a year ago, they might be right there, right?
And that's when you get the chance, which mortgage companies are in the money business. They're not into trying to pursue anybody. But why people do it, because some people, they don't know what it's called. That it's called mortgage fraud. It's a fraud, and that has like consequences.
Big consequences.
Like big consequences. So it's a big no, guys. Don't try to beat the systems when it comes to that. If you're gonna get a primary residence, telling the mortgage company that you're gonna reside in the property, make sure that you reside in the property. If not, then you're committing mortgage fraud, and that complicates things for you. You don't want to find yourself there.
Yeah, and it's not so much that like they're worried that you're not going to make your payments, right? What happened to get a little bit, behind closed doors is that mortgage eventually, when they go to sell it to Fannie Mae and Freddie Mac, they're going to do their investigations. Like, hey, I'm not buying this.
Correct.
So whatever mortgage company did it is now stuck with a mortgage that they're paying, that they paid 8% interest to give out. and they're only collecting 4%, 6% every month.
Correct.
So they're losing money every single month because they couldn't get rid of that loan. And the only way to get rid of that loan is to sell it on the secondary market at a loss. So they'll sell a loan for 400,000 for maybe 350, and they're not gonna. They don't care about you.
And that's complications that they don't even find out. The ultimate borrower, they don't find out because that's in the back end. What happens behind mortgages.
Yeah.
And that's why whenever you move into the property, you receive 3 months later a letter that they changed your mortgage company, because those loans, majority of mortgage brokers, they ended up selling it on the market.
Yeah.
So it complicates when people do those kind of things. They're not only putting themselves in that comfortable situation. It's like also the mortgage broker that ultimately did that loan.
My favorite one is when people say that they're gonna buy a house and live in it as a primary. Minutes after closing, it's for rent on Zillow.
Yeah.
You were just asking to get caught here.
No, it's and it makes sense. Nowadays, it's gonna be more tricky. Now that you mentioned AI, I think I asked Robert back when we were on the trip. The mortgage industry, it's a lot of paperwork.
Right.
In between. By the time that you fill out a pre-qualification until underwriting the deal, it's a lot of paperwork in between, in qualifying, checking on credit, on income, on assets, and all of that. But now with technology and AI, it's for years and years, most mortgage companies trying to get a better, unique value proposition. The way that they do it is try to minimize and optimize that process. With AI, I could see that taking like a big quantum leap, where like I can submit an application and I know today if I qualify or not, and I can pretty much underwrite the deal right away and shorten that amount of time so much. Where do you see the mortgage industry going when it comes to that?
So AI is just a tool, right? Same thing of kind of like when the internet and Home Depot and all these places came out, like they thought they were going to be replaced, right? But people, especially in South Florida, right, where there's a lot of immigrants and people like that want to feel good buying a house, a lot of people still don't trust just a robot and AI to get a mortgage, right? So they're still going to want that face-to-face and person-to-person interaction, but it definitely does make our life a lot easier. And for the most part, not for the most part, but I see a lot of times not making people dumber, but think less critically.
Yeah, correct.
Right? So they'll just upload bank statements or do this or do that, and I'm like, hey, but did you check this or did you check this? Like, they might upload bank statements.
I can see that it's true.
They'll upload
loan officers using AI to
this is the people at the office. When you hear this, they have income calculator worksheets, and I'm like, why are you guys doing this? Like, for example, this happened the other day. They'll upload bank statements, right, to get the income calculated. They didn't look at the bank statements. They didn't realize the guy's paying $8,000 a month in alimony.
Yeah.
They know the guy's making $30,000 a month, but they didn't check that the alimony's there.
And it's like, oh, if ChatGPT is telling me this, no, well, it's gonna tell you what you want to hear based on what information that you gave it.
Exactly.
That's crazy, and it's funny that you say that. But I agree with you. Even on the real estate side, which has been a conversation, ongoing conversation, if is technology going to replace those real estate agents? And I do believe, I agree with you. Like the negotiating part, I don't see that leaving, because the negotiating process and people wanting that tailored conversation is not going to disappear. Now, I'm talking about on the processing part, on the underwriting part. Right now, for example, what is your loan commitment time, average loan commitment time?
So you see it. We get CTCs now in like 5 business days, which is like a week, days. Right? And if a file's clean and we have everything, we've changed our process a little bit to be a little, not work as fast in the beginning, collect all the documentations. And like, for example, like we'll get the insurance up front, right? So we can get the CD, which is like the realtor's like, oh, I know we're good. The CD will come out at initial approval because we already have the insurance. But for example, when we upload documents to the underwriters, they use AI. Right? Instead of having to look through a business tax return that's 67 pages, the AI will automatically skim through it and go line 37, boom, line 8, depreciation, this, and it'll organize all the stuff. So it saved the person time scrolling. So the underwriter will just go, okay, these are all the numbers. Let me check for them here. Boom, boom, boom. It all adds up. This is the income calc. On to the next.
Wow.
So, like for example, there's instead of having to upload bank statements anymore, Plaid, which is the same system Cash App, Venmo, all these things use. Upload it, it downloads within seconds, 90 days of transactions. Instead of having to go into your Wells Fargo, print a statement, download a transaction history to show you gave the escrow deposit, you sign into your bank account, pulls 90 days of transactions, all the withdrawals, all the deposits, and you're done.
Wow. You know,
way quicker.
Hearing you out saying all of that, it gets me excited, because when you look at from the real estate part, in transaction-wise, what takes the longest on a file is the lender part.
It does.
It's the lender part. The title searches is 1 or 2 weeks, depending on the city. But the inspection, it's done in the first 7 days. After that, it's HOA approval and lender, if there's an HOA. So that gets me excited, because that means that with time, we're gonna shorter the typical 30 days that everybody counts with. I can see it, 2 weeks?
I see it happen all the time. No, like the industry's changed so much, and like I've been doing it since 2018 to now is 6-7 years.
Yeah.
The go-to is like rush the lender, right? Because it usually takes so long, right? Lender.
I did my job. The inspection is done. Everything is good.
Right? And now it's getting to the point like, hey, when can we close? I'm like, I'm ready. So now because of all the tech and all that stuff, like I'm usually ready before title. So I'm like, it's notorious. It happens every time. Hey, can we close early? Yeah, let's close early. And no one asks the title company.
Yeah.
Survey's not back. Title commitment's not there. Or there's liens and all that stuff too. So people just automatically resort to rushing the lender. But because of the AI and all that stuff, the lending process has gotten so much faster, much faster.
And it was nice on the trip that you invited me and the other guys. It was nice to see who are your partners, the wholesalers, and how much technology and money it's invested in that process.
It's a massive operation, right?
It's massive. It was very, very impressive, and it's like, man, that's where the industry it's heading, and how big it is on the back end. So it's exciting. I'm curious to see how everything. I'm excited for that, because on the real estate side, it's like, man, I just want to get the client under contract, and then try to move on to the next process as soon as possible, the next line, and that will ease the process so much.
It makes the client experience better, right?
Yeah.
So I'm a big believer on client experience, right? Like no one's gonna remember you because you got them a quarter or an eighth of % better of an interest rate, right? But if the person was so pleasurable to talk to, you made jokes, right? You enjoyed working, you closed easy, they're gonna remember you, right? So with these wholesale companies that we work with, they make the client experience so good and so seamless. It's like, wow, is that fast? That good? Like, that's what brings you repeat clients.
Love that. Guys, Eric Rodriguez, loan officer here in South Florida. If you don't know this guy, if you don't follow him, I make sure that you do so. I'm gonna leave his social media below. Man, it was a pleasure. It's been nice being working with you, and exciting for work on in the future.
I have been waiting for this invite for a while, bro. So
Thank you, bro. Thank you. Appreciate you.